Let's go back a few years. I'm going to take you back to 1990, back to Japan. At the time, equities were trading at something like 85%, 85 times earnings, just crazy. Property prices have gone through the roof. The market starts to tumble. The economy starts to collapse. The Japanese government does what they can. But ultimately, in a situation like that, even if it would have happened today, I think the central bank could do nothing other than take the edge off it. So the market fell 85%, maybe it only falls 60. The market took, well, actually, the Japanese market still isn't above its levels of 1990. I think if the central banks had done everything they could, they'd still be below that level. And so in the event when something fundamental is happening that is real and big, all central banks can do is round the edges. They can certainly impact sentiment. And so if it's a downturn that's driven by sentiment, they can do a lot about that. If it's a downturn driven by fundamentals, there's not much they can do about that. And so,
do you think COVID didn't have an element of fundamentals?
It had this much fundamentals and about that much, if I can get it on, panic. And that's the point of the valuations. When you go back and say, well, what will earnings be in 10 years' time as a result of all of this? And if you're saying, well, maybe they're down 10 or 20%, you'd probably say, look, I should be taking maybe 10% off prices, maybe 20% off prices, but not 35%.